What's up, guys? Welcome back to another video. Thanks for tuning into Stock Essentials. Today we're going to be going over AMC stock and an option strategy that can yield you potentially tripling your money, which is going to be a very good investment for many people. It's going to be very appealing to people, especially with small accounts. This strategy is perfect for people with small accounts because we're going to be doing a two options order strategy called the put credit spread. And on volatile stocks like AMC, you want to do credit spreads rather than debit spreads because the implied volatility is going to be very high and the premiums are going to be a little bit higher on the options as well. So if you do a debit spread, you're going to be paying a little bit more money, whereas if you sell a credit spread, you're going to be receiving a lot more premium because the premiums are a little bit inflated right now. So let's head over to the options chain and we will do the July 2nd expiration date. Let's head over to the calls and we'll first see how the difference is between the calls and the puts. It's not that big of a difference, but there is a slight difference. You're going to be receiving a little bit more profit on a credit spread rather than a debit spread on AMC. So we'll select the $59 strike and $60 strike. So this is going to be an example as a debit spread, a call debit spread, which is the same as a put credit spread, except one you're paying a debit and the other one you're receiving a credit. So for this one, we're going to be buying the 59 strike calls and selling the $60 strike calls. As we can see, our total cost is going to be $25. This means that our max profit is going to be $75 per contract because our max profit is going to be the width of the strikes, which is $1 multiplied by 100. So it's going to be $100 minus our cost of $25, giving us a max potential profit of $75, as we can see here. So this is going to allow us to triple our money with the call debit spread, but we will also check out a similar strategy. So let's call debit spread. We want the stock to stay above $60, and then we make our full profit of $75, which would be tripling our money. So as long as AMC stays above $60 by July 2nd, you're tripling your money. Let's head over to the put side. We're going to be selling the $60 strike and then buying the $59 strike. So this is a put credit spread, which is similar to a call debit spread. We're going to be receiving a credit instead of paying a debit. It is a bullish position. We want the stock to stay above $60 by expiration in order to make our full profit. So we'll buy the 59 strike and sell the $60 strike. As you can see here, it's going to show up as a put credit spread. But we're receiving a credit of $77. So it's slightly more profit than the call debit spread because we're only going to be putting up $23 of collateral per contract because we're receiving a credit of $77. So to make this full profit of $77, we're going to want the stock to stay above $60 by July 2nd, which gives us a lot of time. And I recommend that you close out the spreads early, though, in case something happens on the day of expiration. You don't want these contracts exercising, so it's best to close out your contracts early when the premium has bled out enough and you're up enough profit. And just like how you're opening the credit spread like this, that's similar how you would want to close it as well, except buying the 60 put and then selling the $59 put, just reversing your actions there. So this is a really good strategy for people with small accounts because as we can see here, it's not really going to be costing you that much money. For this put credit spread, we're only going to be putting up $23 of collateral because it's going to be the collateral of $100 minus the credit we're putting up, which is $78. So we're only going to be putting up $22 of collateral so we're risking $22 with a potential to make $78, assuming that AMC stays above $60 by July 2nd, which it very well might be, because AMC has a lot of momentum right now, a lot of bullish movement, especially in the options chain. We made the video on that in the previous video. A lot of bullish momentum. A lot of people are pouring their money into AMC stock, and it's holding this low $60, high $50 range pretty nicely. So that's a very good sign that this price point is very justified, and a lot of people are going to be buying more AMC. The momentum should continue throughout the week with a potential squeeze sometime in the future. So this would be my recommended option strategy for people who want a little bit safer of an option strategy. If you outright buy calls, you are going to get hit with the data decay and the IV crush. Whereas when you're selling a put credit spread, you want time to decay. You want the stock to stay flat. You won't be losing money on your options. Instead, you will be gaining money by having the stock stay flat, whereas with a naked call, you're going to be losing a lot of money. But the downside is your risk reward is limited. If AMC goes to $1,000, your max profit is going to be tripling your money at most, which is not that bad. And this is really good for people with small accounts because it only takes $22 of credit of debit in order to put down for this credit spread. So if you have a $200 account, you could put down $200 of collateral, and you can open up 100, and you can open up 10 of these put credit spreads with the potential to make $780, which sounds pretty good. Leave a like if this video helped you anyway. Comment down below if you have any questions, and consider subscribing if you're new here to the channel. It helps out a lot. Thanks for watching.